So we are going to just get started and hopefully have enough time at the end for questions, but we have a lot of really good information to share today. So navigating medical practice transitions is the topic of the webinar today. And your presenters are myself, Lauren Duren. I'm a director in our client advisory services group here at Lutz. And I also have my co-presenter here.
Hi everyone. I am Mark Otte. I'm a CPA and I'm a director in our M&A group. So I do business valuation work surrounding mergers and acquisitions, along with sell-side advisory work.
So Mark and I work a lot together on this topic specifically with medical practice transitions. And so what are we talking about today and why is this important? You know, we keep hearing about the fact that we are approaching this silver tsunami, which is really a metaphor that many are using today to just describe the aging population. And many of our clients that we work with have expressed major concern about their own transition plans or lack thereof. So we know that this is a very prevalent topic in the industry right now. And our population in general is aging, but with that, our physician population is also aging. Patients aged 65 and older currently account for 34% of physician demand. And in a decade, that's going to account for 42% of physician demand, which will obviously require additional physicians. However, in the next decade, 2 out of 5 active physicians in the US will be older than 65. So just by pure numbers here, the volume of physician transitions and then the volume of the increasing patient population is going to be a little disproportionate. And with that, physicians transitioning their work in medicine is going to increase in these upcoming years. So just a few stats that are very interesting and kind of highlight the importance of what we're talking about today, but also the urgency of addressing physician retirement and transition to life after medicine is critically important to address now. You know, we want to ensure the survival of these medical practices. And in order to do this, physician groups really do need to be aware and start the transition planning process. And that is really what we're here to talk about today, is to help give you an idea of what transition planning includes and how to get started. So here's today's roadmap for what we're talking about. Obviously, we'll go into what is transition planning and everything that entails, what the options are for transition and exit planning. We'll go over valuation, tactics and essentials, and the case studies examples that go along with that. So a lot of really good information. We'll hopefully have time for questions at the end, but also happy to answer anything offline after this.
So what is transition planning? You might hear other people call it exit planning or succession planning. It's really all the same thing. And we think of it as creating, preserving, and harvesting the business value. And so, as you can imagine, it might take some time. This isn't something we think you should do when you are close to being ready to sell your practice or sell your shares. You know, we recommend beginning several years in advance just to understand the basics of transition planning and business valuation itself. And so it's a matter of, you know, focusing on building a management system that keeps the practice operating and valuable post-transition.
So we have several clients who, you know, think they know when they want to transition out of the business or when they want to start transition planning. And this is everything from, I think I kind of know when I want to retire. This is all great, but sometimes just the need for transition can be unexpected or occur much sooner than originally planned. There's the 5 Ds, which we'll get into. A lot of these things are not necessarily planned or anticipated.
Yeah, and so like Lauren mentioned, you know, timing is a big deal, and very rarely does the timing of transaction occur when the owners actually think it might occur. And so the 5 Ds that we mentioned, death, disability, divorce, distress, or disagreement, all of these can lead to a needed transaction that might be sooner or even later than owners think. And approximately 50% of business exits are not voluntary, which is a surprising stat to keep in mind.
So we often see, why do owners delay starting this process? Physicians in general know they're not going to work forever, but why would we delay transition planning? First and foremost, the process itself is relatively overwhelming. They may not be sure where to start or how to start the process. They may not necessarily have the right advisors in place, or may have a hard time starting these conversations or understanding what their own personal goals are, or any of those 5Ds that were just on the previous slide. Maybe a death in the family has caused a change in timeline, or just in general, we're all busy, and physicians are no different. The day-to-day of them seeing patients and just running the business can be very time consuming. So time may not necessarily be allocated or reserved for their long-term planning or what's the next step, because they are typically just putting out the next fire or managing the day-to-day. We're really not reserving time to give thought to the future. Oftentimes I hear clients just thinking about this as an additional expense, or this is just going to reduce my take home pay because I'm going to have to bring on a new employee or spend less time seeing patients to give thought to some of this. Or if I bring on a new owner, that's going to impact my comp. And all of these things we typically hear are reasons why people just continue to delay giving thought to this. And then a big one, they just may not be sure what life after practicing medicine looks like, or understand the benefits of why we should start this planning process now.
So there's two main types of common readiness issues that we see: personal issues and financial issues. So we'll briefly walk through a few of these. On the personal side, a lot of times shareholders are not on the same page with transition plans. So there's decisions on who will and should be our successors. Sometimes there's aging physicians that might have a plan in their mind, but other shareholders may or may not be okay with that plan. Also, the owner just may not have any goals or objectives yet around their exit plan and timing. Maybe no consideration to what's next, just because they're so busy day to day, caring for patients, that they don't really think about life after practicing medicine. And then also no contingency plans, where maybe the doctor thinks, or the provider thinks the answer is, we'll just shut off the lights and close down the practice, rather than understanding that there might be other viable options to keep the practice alive and well. On the financial side, a lot of times the financial plan doesn't consider the value of the business, or the owners don't necessarily know what the value of the business is. And so when we consult with owners, we kind of give them, we work with valuation, or our valuation group works with the owners to understand what's the valuation of the practice, how does owner comp look now, and how would it look post sale. It's also important to understand the net proceeds. Anytime a transaction occurs, there's usually some sort of tax impact, and so understanding the take home cash flows of the transition is important. And then also sometimes, we think bringing in a financial advisor early on is useful, just to understand the provider's income requirements post transition. We just want to make sure that once providers sell and their annual compensation goes away, is their retirement timing still on track for what the physician had in mind for their retirement goals. So on to a few benefits of planning. We're not going to go through all of these, but we've highlighted 4 on the top page of this slide. So the first one being the main benefit of planning, obviously, is helps the business achieve its goals and the owner's personal goals. And so essentially, and the second one, pushes the business to be best in class. So what improvements need to be made to make the practice marketable and successful? Number 3, control how and when they exit the business. We believe if the owners have a plan, that they're more in control. And anytime you're more in control and have a plan, there's a lot more employee certainty. We see a lot of times employees, there's uncertainty if they don't know what the succession plan looks like of the practice. And so as the owners can plan and have transparent communication with the employees, we've seen that to be very beneficial. And then lastly, it ensures the survival of the business. And when the owners exit, we think it's key that the practice has to win when there's a succession plan. And so what decisions need to be made to make sure that the practice can both survive and that the patients can get taken care of post sale. Also a few other ones that reduce, like we mentioned, reduces employee and family uncertainty, minimize the tax consequences of exiting. There might be certain types of transaction structures to consider, which could help with minimizing the tax impact. And, lastly, it just secures the future of the owner, families, and all employees. So what are a few successful plan components? First we think you should start off with considering what all transition options are there. Who could you sell to? Could you sell to current providers? Do you need to sell to a third party like a hospital or another clinic? Second, understanding the management team. Are there any positions that need to be filled prior to the sale or, along with the sale? A lot of times we understand that owners kind of are or could be a main component of the management team. And so without the owner in place, what roles need to be filled if that owner walks away? Third, assess the quality of your practice's financial trends. It's very useful just to understand your current financials, understand, are you trending up? Are you trending down? What key performance indicators, help tell a good story for the practice? How are reimbursement rates looking? Are patient volumes up or are they down? And, always preparing a budget, we believe, for next year is helpful too, just to give buyers a sense of, what's around the corner. Like I mentioned before, know the value of the practice and what drives the value, which we can get into, or we will get into later in this presentation, and then understanding the tax aspects of the various options. So like we mentioned, doing a net proceeds analysis to understand what are the proceeds the owners will walk away with post-sale, and then understanding the type of the sale or the structure. Is it going to be an asset sale or a stock sale? Depending on the type of sale, that could impact the proceeds to the owner. And then lastly, put together an action plan. And so a lot of times when we're doing advisory work, we're working with the practice's attorney. Maybe we're talking with the financial advisor as well from the individual owner's perspective. So really it's a group effort between your CPA, attorney, financial advisor, and then the owners of the business themselves. Okay, the key three, we call these kind of the three legs of the stool. And so the first one, optimize the value. This is where the remainder of the presentation will primarily focus. We're really not going to get into more personal financial readiness or life after business planning. It's really just to get owners thinking about there's more to it than just, let's say, business valuation and understanding what changes with your compensation. Is just making sure that, there's personal issues as well. And there's even life after business. So what to consider, we've kind of put it into three main boxes. The first one being determine which strategy is most suitable for your transition. So for instance, you could sell the whole practice to a third party. So that'd be a 100% sale, or there might be a partial sale where you sell the operating entity PC, but the real estate is still owned by the entity. And so a lot of times smaller practices or clinics will have real estate that's owned by both, or, by the current owners. It might even be owned in the same entity or in a separate entity, but the real estate doesn't necessarily need to be part of the sale. And then last, sell to employee providers or other co-owners. So that'd be more of an internal transaction where you may not have to sell to a third party. Second, what are you looking for in a potential buyer? There could be certain goals depending on the owner's preference. Is the main goal to maximize the immediate sales price? If so, then perhaps selling to a third party like a hospital or another competitor might be the best fit. Or could it be to minimize operational disruption? If that's the case, then perhaps selling to current providers or current co-owners would achieve that goal where they're familiar with the operations and not much would change post-sale. And then lastly, ensure your practice is turnkey ready. Really, the main point is just to make sure that practice continuity will continue and it allows future owners to operate the same as before with steady income.
So as Mark kind of touched on this, what are the typical transition planning options that we see these independent groups when it comes to transition, and who are we selling to and who are we transitioning ownership to? Obviously touched on this option to sell to a third party, which would be a hospital or another practice, maybe another practice looking to acquire another location, or get into your particular patient base depending on the specialty, or looking to grow their own practice by acquiring yours. And then there is the option to sell to existing partners and providers, whether that is an employed physician looking to gain ownership, or the existing partner group looking to expand their current ownership. And then least likely option, unless you have a family member practicing medicine or something similar, would be to sell to a family member. And we're going to kind of explore the pros and cons of all of these options next.
So we'll start with a third-party sale. Some of the pros, usually there's a higher price. So a third party, such as a hospital or competitor, might be able to pay a higher price than younger current physicians that are practicing. Usually there's an opportunity to receive more cash up front. Third parties usually finance the deal with bank debt, which means generally you as a seller would get more cash right away at close. Possibly you could walk away faster, and there's more stability of deal terms. Again, if you've got a stronger financial buyer, hopefully the deal terms don't change as you're working through the process. There might be business refresh, maybe there's new growth goals or plans. And lastly, it would break the deadlock at any management level, where if there's a new third party owner, they would most likely have control of the entity. And so that would break any deadlocks. Some of the cons, it can be a long process to sell to a third party. A transition can take anywhere from 6 months to a year even. It could be a distraction or a loss of focus. There's a lot of effort that needs to go into selling the clinic or the practice. And so a lot of times that might take away from day-to-day operational needs that the owner needs to focus on. And kind of one of the main cons in this industry, at least, is there's no future ownership for younger providers. So if younger providers came into the clinic wanting or hoping for ownership, a third-party sale would pretty much take that off the table. And then lastly, if you have an advisor, there could be higher costs when selling to a third party, and there might be privacy concerns where if you've shared any confidential information with a third party, and if the sale doesn't happen, then they've received information about the business, but the deal died. On to a sale to existing partners. Some of the pros, it's less disruptive. So if some of the current providers are buying in, they understand the operations, it could be planned. You could be discussing this with other providers months or years in advance. The buyer should be more well-informed than the third party that's maybe not as familiar with the practice. And it could be a controlled process where if you've got a buy-sell agreement in place, the buy-sell agreement could make things run a little bit smoother with lower costs. If you don't need to necessarily hire one or several advisors, that would help keep costs down. Some of the cons, sale proceeds could be smaller. You may not necessarily get the highest price or maybe the best deal terms from the seller side of things. There could still be competency gaps. If there's gaps in the management team that existed pre-sale, those still might be there, post-transaction. And then the buy-sell may restrict selling options. And so a lot of times in a buy-sell agreement, you might have to first offer the stock to existing partners prior to receiving or selling to a third party.
This is probably the most common form of transitions that we're typically dealing with. And like Mark mentioned, you have a well-informed buyer, which is a pro. And then back to the idea of confidence with the rest of the team or other employees, if they foresee these future owners who have been working with the practice as good leaders, that could be a pro for the remaining team at the practice. And then that could also be a con if they didn't view that person as kind of the next leader. So the process itself, we do see sometimes when an employed provider comes into the practice, we're already talking about ownership from the day they're there of, hey, what does this timing look like? And bringing that person along on some of those management decisions. So this is really something that I think some providers think, oh, I'll just sell to my other providers, but they may or may not have interest in becoming owners. So this is one that we see is very common, and should still fall into that planning process that we're talking about here. So Mark kind of touched on a buy-sell agreement. And so when selling to an existing partner within the group, there's usually a buy-sell agreement that's in place, which is baked into the documents of the entity, whether it's your operating agreement or a specific buy-sell agreement. And it's usually a legally binding agreement between the owners that facilitates sales, how the transfer of ownership is supposed to work, or any restrictions in place. So there could be a stock restriction agreement in place, and a formula that will dictate how the valuation is going to work. So it's going to actually outline the methodology, the valuation methodology, and the formula that we're using to purchase or sell the ownership interest in the practice. And, you know, we see this about half and half. A lot of the groups we work with already have a buy-sell agreement in place. And then a lot of the groups that we work with have to create a buy-sell agreement because of a triggering event, which gets me to the next slide here. A common triggering event is kind of the need to spurs the need for creation of a buy-sell agreement. So oftentimes there's going to be an ownership transition. We ask the question, do you have a buy-sell? If they say no, well, that obviously triggers the need to create something and get something in writing. Some of those triggering events, obviously an owner retires or terminates employment. One of the 5 Ds happens. In this particular case, an owner, death, disability, or divorce. Or perhaps there is interest from an outside party that comes in and offers ownership or offers to purchase the practice, and then that starts to trigger the, okay, should we consider this, or do we need to look internally, and what are our options for transition? So why would we do a buy-sell agreement? Well, it creates stability for both the business and the owners by ensuring there's a predetermined method for succession planning, whether it's internal, also can dictate timelines. And a long time ago in the 90s, I think there used to be this idea of a lot of goodwill or blue sky in these independent medical groups, but really a lot of times the real value in the company is paid out in the form of compensation year over year. So there's not what used to be considered blue sky. That idea has really gone away. And so having some type of buy sell in place will really outline what the expectations are for the methodologies used under a transition structure. And now Mark's going to kind of talk a little bit more in detail about the methods for determining the valuation or the purchase price.
So some of the most common methods that we see are the first one being formula based, this is usually the most likely formula, or the most likely method that we see, where it's usually the valuation is based off of a multiple of book value or earnings. And so a lot of times we might start with the reported book value of the practice and make certain adjustments, such as adding any assets or liabilities that are not currently recorded on the books that do have value. The second one being a third-party appraisal. So that would require the need to hire an outside appraiser, and that appraiser could then say, I can use any method I so choose. And then you're kind of really leaving it up to a completely independent third-party appraiser to determine the valuation. Or lastly, it could be a fixed price, and if it's a fixed price, it's probably going to be a lower value, just because a lot of times if they've determined that the value should be fixed, it probably means that all profits are being paid out annually in compensation or in bonuses. And so, like Lauren mentioned, there may not be a whole lot of goodwill or blue sky just because all profits are paid out via compensation.
Okay, so now that we have an idea of how the purchase price could be determined, what can we do to drive that value?
And so what, if you take a step back and you think about what drives value, there's really kind of two main areas on how the value could be increased. One being higher profits, or two being lower risk. And sorry, we're working with the screen here. So just a few main drivers. You know, like I mentioned, anytime you can increase profits or lower the risk of the business, that helps to increase value. And so having management or provider strength and depth is one. Having recurring revenue and a recurring patient base is another. A diversified revenue base, favorable contracts with payers and suppliers. Again, anytime you can have more favorable reimbursement rates or lower costs, that should help to increase profits. Being a leader in a product or service, having a clear strategy, processes, and operations. Again, this kind of goes with making sure the practice is turnkey and that continuity of operations can be continued. Solid growth profile. Any buyer wants to see a practice that's at least stable, if not growing. Having margins at or above industry averages. And lastly, having clean financials. And so whether that's getting your CPA to step in on an annual basis and do reviewed numbers, or even compilations, just making sure the financials are clean and accurate is very important.
So just to kind of touch on a couple other value optimization techniques, the goal really here as well, if for these independent groups, is to drive the amount of earnings available for compensation by the owners. So a lot of times we're looking at when we're looking at how to value these independent groups, there's a lot of trends that show reimbursement is decreasing while expenses are increasing. So what can we do to increase our revenue or decrease our expenses, or both, right? And so in terms of revenue, we can look at reimbursement. How can we increase reimbursement? Are there any procedures that can be put in place to improve payment collection? Do we have a really solid collection percentage and process already? Are we reviewing our fee schedules? Is it time to renegotiate any contracts? Things like that, to ensure we're maximizing the reimbursement that the practice is getting. From a productivity standpoint, do we have any providers that can increase productivity? Are we best utilizing our team? Are we leveraging where we can to our advanced practice providers? How can we lessen some of the administrative burden that our physicians are currently doing so they can spend more time doing what they do best and providing patient care? From an internal operational standpoint, what tweaks need to be made from a value optimization perspective? And then that last one, maintaining the patient base and showing growth, kind of goes back to, are we leveraging and utilizing our providers correctly? Are there strategies here that we can implement, which is going to be completely dependent upon the specialty of the practice, what makes sense there, but leveraging and utilizing the providers, other clinical staff in the most efficient manner while maintaining quality patient care and showing growth, or even if that's additional locations and additional opportunity for revenue and different service lines, perhaps, things of that nature. All facets to look at from a revenue perspective. And then on the expense side, thinking about our major expenses and understanding how are our physicians compensated, both our owner physicians, but then also our employed physicians and the different components of that compensation. We know there's still a vast majority of folks on a productivity-based compensation model. And so how does that look post-sale, or how does that look right now with the current provider group, and with the transition and what providers are leaving? How does that impact these expenses? If it's a really high producer, maybe they have a large compensation expense due to that, the nature of that model. Have we considered some of that? But then also other major expenses of the practice in these particular instances with an independent group, there may be some expenses that are at the directive of the owners. So that third bullet point there, identify any owner discretionary expenses. Maybe we have a particular provider who has pretty expensive continuing education because of the locations they're choosing to go to for their continuing education. Some of those expenses that may or may not be in existence post-transition are things to give thought to. And we're going to talk through some of those discretionary expenses in a little bit more detail and how that would go into determining the value of the entity. But it is important to understand your different expenses, which are required, which are discretionary, the general expense practices. We have some groups who, from an inventory management perspective, buy all of their supplies when they need it, depending on the specialty. Others want to have certain supplies on hand, and they have 3 months supplies on hand at all times. And so what are the expense practices of your practice? And again, determining what are required versus discretionary, and then thinking through how you can negotiate or have expense management practices is another area from a value optimization technique that could be considered. And then there's a few other items that should be considered as well, aside from revenue and expenses, which we kind of have touched on a few of these, but streamlining operational efficiency and really ensuring, are we looking at our KPIs on a recurring basis? What are our trends? What can we do internally to ensure that we're operating as efficient as possible? Strong management team. Are our owners integrally involved? Do we have a very strong practice management team? Is there anything changing there? Does the fact that an owner is going to be transitioning change anything with the management team? How involved are they? What decisions are they making? Do we need to bring others along? All key things to consider. Mark touched on building a budget and compared to actuals. This is a big thing that I think a lot of people overlook, building a budget, but can be very helpful when you are projecting to the future. And then also consulting with the experts. Are your financial statements reliable? When you may have heard of some of these examples before, and then you run your internal reports, and you may have a number in your head that may or may not be close to an actual valuation or a potential purchase price. And so ensuring that you have fair, accurate, and adequate financials, and that's going to be really huge in just ensuring that you get fair, accurate, and adequate proceeds for the business upon a transition. And then the practice's intangible assets must also be transferable. So giving thought to what of those types of things exist and how that would look in a transition of ownership as well.
Okay, a few main transaction considerations. One being the deal structure, and we've kind of mentioned a few of these already, so we'll kind of slide through these. But deal structure, if you're selling to a third party, think about, do you need to sell the assets or can you sell the stock? There could be certain tax implications to both. Generally, selling the stock could be more seller friendly. If you're selling to current providers or current owners in an internal sale, think about, should you be issuing new shares of the corporation, or do you want to sell existing shares? Second, what assets and liabilities are included with the sale? So like I mentioned before, maybe you are or are not including real estate in the deal. Maybe accounts receivable will or will not be assumed or sold. And maybe certain debt items won't be included with the sale as well. So looking through the balance sheet to understand what assets and what liabilities are we going to try to sell. Deferred compensation, a lot of times deferred comp goes with any buyout. And so if you're the seller, just want to make sure you understand how and when payments will occur post-sale. Financing, Usually any buyer is going to finance the deal with some sort of debt. And so whether it's bank financing or seller financing, making sure that financing is locked in can help reduce risk of the deal failing later down the road. And then understanding as a seller, will you be receiving an upfront cash payment, or it might be long-term financing if the seller ends up needing to finance a certain portion of the sale. And then lastly, income taxes. So just like we mentioned, understanding what's the take-home sale proceeds, whether you're selling assets or stock, whether the seller is financing some of the deal themselves, they're going to be receiving a one-time payment at close.
All right, and at this time, I'm going to launch a poll for anyone who needs CPE credit. Just answer yes to this poll. And if you need a CPE certificate, you can send an email to the email address on the screen.
Okay, on to now more valuation. We're going to walk through a few different valuation methods and a quick case study if we have time. So at the bottom of the screen here, you'll see that, well, let me back up. Valuation is usually based on either a multiple of cash flows or the hard asset values. And so a lot of times during a sale, you might come across the term EBITDA. And what EBITDA is, it's earnings before interest expense, taxes, depreciation, and amortization expense. And so EBITDA is really, it's a form of profit where it looks at the business's profitability from its core operation. So it's not including depreciation expense, because depreciation expense might be accelerated and depreciation can commonly reduce taxable earnings. So EBITDA is before depreciation expense and it's before interest expense or any debt service. And then, so there's reported EBITDA or EBITDA, but then there's adjusted EBITDA, where adjusted EBITDA removes various one-time, irregular, or non-recurring items. And so, like we've mentioned, if there's any owner discretionary expenses and whatnot, the goal is to remove certain expenses and revenues that will not continue post-sale to come up with adjusted EBITDA. And so once you've calculated adjusted EBITDA times a multiple, that equals the enterprise value or the value of the business on a debt-free basis.
So I think a lot of times with these independent groups, we are looking at, earnings available for physician compensation. And this is really changing the lens in which that gets looked at. Net taxable income is typically the number that drives a lot of the compensation calculations that a lot of the groups on the call are probably following. And so this is really, again, changing the lens a little bit. It's adding back certain line items to really get to a true core business operations net income, essentially, as Mark mentioned. And then again, some of those discretionary expenses that some owners may have specific to them that wouldn't really be true for anybody walking in, or just true core business operations, those all get added back. So it's another form of net income, but it is a different lens to look at this from a valuation standpoint.
And so we've listed a few of the common EBITDA adjustments that we usually see. The first one being owner salary and compensation. So it's important to understand that this owner salary and compensation needs to be at fair market value. There might be other owner related expenses such as maybe there's personal vehicles, travel, country club dues, or entertainment where the owner themselves is in control of that expense, and post sale, those wouldn't continue going forward. Rent expense, it might be, it's common where the real estate could be owned within that same entity, and since it's owned in that entity, there may not be fair market rent. And so if that real estate will not be included as part of the sale, any potential buyer would need to pay rent expense to the seller. And so we would want to include a fair market rate of rent if the real estate will not be included with the sale. Gaps in the management team, maybe there's new hires that need to be made. And so understanding what's the replacement cost for certain employees or any new employees. And then there could be any historical legal costs or litigation items where there might have been a one-time event that any revenue or expense should be removed due to that one-time item, just to understand a normalized level of revenue, expenses, and profits going forward. So there's three main approaches to business valuation. The first one being the asset approach, which is fairly common for what we see for smaller practices or clinics, where the equity value is determined based on the market values of the balance sheet assets and liabilities. And so what we'll do is we'll adjust all assets to market value. So for instance, we would want to understand what's the actual collectible accounts receivable amount, how much inventory is on hand. A lot of times clinics might immediately be expensing inventory, but they might have, there's still value to inventory. It's just already been expensed. And so we're adjusting the balance sheet assets up to market value, and then making any adjustments to liabilities if needed. For instance, maybe accrued payroll, or maybe the payroll isn't accrued, maybe it's on a cash basis. So understanding what liabilities there are at month end or year end to understand the true equity value. Second, the income approach. So when I mentioned EBITDA up a few slides, this is under the income approach, value is determined based on the free cash flows or profits of the business. And so we would look at what free cash flows would be expected post sale, and then we're discounting those to present value based on a required rate of return for the buyer. So we're essentially saying how much profits are there, what's a fair rate of return for those profits, and that's what drives the value. And then third, the market approach, that's where you can look at sales of other similar companies and understand what, and apply the same multiple that those were sold at to the current practice. And so it might be tough to find truly comparable sales for smaller clinics. Sometimes we can find sales, but they might have been many years ago, or it might have been a different specialty. And so the market approach can be tough to find certain multiples, but through the asset approach or income approach, those are two of the main methods we use.
So in terms of preparing for going into some type of valuation system or steps or process, there's several documents that would need to be reviewed or analyzed by the valuation team and other advisors. And so we have a few listed on the slide here, but obviously subject to whoever the advisor is and whatever valuation approach or methodology they're using. But historical tax returns for typically at least the last 2 to 3 years, sometimes up to 5, historical financial statements. A lot of times the historical financial statements are sometimes required on a monthly basis. So you may have annual financials, but a lot of times they'll want to see this on a month over month look for the same time period. If you have any financial projections for the future or some type of budget, payer mix, and other statistics such as production by provider, other volumes by provider, by location, by service line, whatever is specific to your practice, specific provider compensation, and any of the calculations and supporting information related to that. Any information on related party transactions. So if you've had internal transitions in the last 5 years or whatever time period we're looking at, we will want information on that, how those transactions were done, how those formulas were calculated. And then any fixed assets or real estate details. So from a capital asset perspective, what are we really looking at? Is there real estate? Is this a heavy capital intensive type business? Do we have a lot of equipment, or are we using our supplies on a regular basis? What type of inventory do we have on hand? All of those types of things will go into this process. And so for some of you, you look at this and this may be an easy task. You may already be looking at a lot of this on a regular basis. You may have a lot of this on hand. But some of this, maybe you don't have access to all this information, or it would take some time to compile, or you may need to consult with somebody to assist with getting some of this compiled and summarized and analyzed. So giving thought to a lot of this goes back to, our message at the beginning of this slide is really taking the time to give to transition planning, because it does take a little bit longer than one would think. So I think we have some time for just a couple examples. So we are going to go through some case studies where we're really going through the different scenarios and how this would work under a typical valuation transition with a practice. So this first example, we have 1 physician owner, 7 advanced practice providers, and they have some real estate that is owned by that physician, but that's in a separate entity.
And so when you look at the balance sheet, you'll notice that accounts receivable and inventory isn't reported. So they might be on more of a cash basis for revenue reporting, but they could be accrual basis for liability. So they are reporting certain accounts payable and other liability items. So the first case study, if we just look at the asset approach, so let's say this is for a physician buy-in, and the buy-sell agreement might say the valuation should be done under an asset approach. And so what we're doing is we're adjusting the balance sheet to market value. And so you can see that the reported equity value is actually a deficit of 95,000. And by the time we make adjustments, the equity value is worth 1.2 million. And so if you look up above on the asset side, we're adjusting the balance sheet to include collectible accounts receivable. We're adding the value of any inventory or supplies. We're adjusting fixed assets up to market value. So fixed assets might always be understated if accelerated depreciation is used for book purposes and tax purposes. And then lastly, there might be some intangible assets. For example, it's common to include a workforce calculation based on, total employees or total payroll costs. So there might be some intangible value, but again, that could be specific to, in this example, the buy-sell agreement. So the important thing to kind of keep in mind is even under an asset approach, the book value of equity could be fairly small, but that could also be due to just the books not being truly accrual basis and then even, a market value basis as well. A different example for a third-party sale where you might want to consider looking at the cash flows of the business under the income approach. Under the income approach, we're trying to understand what is adjusted EBITDA, and we want to be aware or make sure that we're making any adjustments as needed. So for example, we've got 3 adjustments mentioned here, one being owner compensation. Maybe owner compensation wasn't exactly at market rates, so we've adjusted that. Maybe rent expense was above market or below market for certain years, so we've adjusted for that. And then there might be some non-recurring income items. And so, for example, in 2021 or 2022, there might have been SBA PPP loan forgiveness income or ERC income. And so the goal of calculating adjusted EBITDA is to remove any one-time income items such as those that we commonly see. And so then once you get to adjusted EBITDA, for example, in this scenario, in years 2022 to 2024, you can see that adjusted EBITDA becomes a little bit more, fairly normalized compared to the reported EBITDA up above. And so once adjusted EBITDA is calculated, then we make several adjustments to calculate free cash flow. So we make any tax expense deductions, any working capital adjustments as needed, and then we're capitalizing those cash flows. So once you calculate the free cash flow and you divide that by a fair rate of return, that comes up with your enterprise value. And then down below, a lot of times we speak in multiples. And so for in this instance, the EBITDA multiple of the practice is 3.7 times, where that's the enterprise value divided by the adjusted EBITDA. The last example, let's say for a third-party sale would be the market approach, where if you could truly find comparable transactions and understand what those multiples were, you could apply those multiples to the adjusted EBITDA of the target practice. And so let's say we were able to see that there were transactions that traded for 4 to 4.5 times EBITDA, then the enterprise value for the clinic could be anywhere from 1.16 million to 1.3 million. And then enterprise value though is generally on a cash-free, debt-free basis, meaning let's say the value is 1.16 million. Usually the buyer would not buy the cash, but they also want to buy the debt. And so generally the cash and the debt remains with the seller, and any sale proceeds are then used to pay off debt. So you can see that by going from enterprise value to equity value, we're adding cash because cash would remain with the seller, but then we're deducting debt because that debt would be paid by the seller. So that's a very quick overview of all three approaches: the income approach, the asset approach, and the market approach.
So a few deal killers that are sometimes, will quote, just like it says, it kill the deal or hinder the actual transaction or transition from occurring. A lot of times this includes some due diligence findings. So somebody starts requesting documents, they look into the situation a little bit further and decide that this is no longer a deal that they want to transact in. Owner, physician dependence, if there's one provider or there's one owner and that physician, kind of ran the practice and there's really no identified new provider, or we haven't done our diligence in recruiting and retaining a new provider to take over the practice, that may be something that would kill the deal. Or if there is nobody to transition the actual patient work to, from that standpoint, minimal opportunity for growth or physician recruitment, kind of what I was just explaining. And then if there's unexpected changes in the company's performance, or if there is some anomaly that changes the performance of the company. Lack of financial documentation is a big one. If there's no compiled, reviewed, or audited financials, is not necessarily an indication of a deal killer, but if there's not clean records available and the financial information isn't readily available, that's oftentimes an indicator or foreshadowing other things that are also not necessarily buttoned up. So that's typically an indicator that may kill a deal. Is this something that a potential buyer would want to get themselves into? And then a big one is any outstanding legal issues. If there's a lot that's maybe unresolved, or there's been a history of issues that may make this particular practice a target for future issues, that's obviously something that would kill a deal with a potential seller.
And that's the end of our presentation. If you have any questions, please enter them in the chat.
All right, looks like there's no questions. I know, obviously some of this is going to be based on the facts and circumstances particular to your situation. So if you guys, any listeners do have any questions, please feel free to reach out. And we can talk through any of your specific scenarios individually. Thanks, everybody. Have a fabulous rest of your day.